Good afternoon. We are Fame Inc., World 16, Team 6, and we are here to discuss our performance for years 5 and 6. I'd like to start by introducing our team.
My name is Carlos Ruiz. I'm the Director of Marketing.
My name is Rita Lam, and I'm the Controller.
My name is Michael Weisinger. I'm the Director of Operations.
My name is Jordan Hodge. I'm the CEO.
My name is Danny Garcia, and I'm the CFO.
We will begin our presentation by just giving you a brief rundown on the topics we will cover, and we will start with our vision and our mission. Then we will move into our objectives and accomplishments, industry analysis, marketing strategy, operations, and finally looking forward for year 7. So next we're going to cover our company vision and mission. First of all, our vision is we are a provider of quality products which provide our customers, reward our employees, and maximize our shareholders' wealth. And our mission is to become the leading provider in the consumer durable goods industry. We will achieve this through providing a quality, value-added product and service that exceeds the expectations of our customers, as well as managing and controlling costs that will exceed and reward the efforts of our employees while fulfilling aggressive growth and delivering healthy returns for our investors.
Hi everybody. I want to talk about our objectives and our accomplishments for Fame Inc. for years 5 and 6. And I want to go over the ratios for ROE, ROA, net income, and stock price, market share, and unit production costs. As you can see, we exceeded our expectations of net income by 1 million, and for our market share, we exceeded by about 1.5%. And for unit costs, we had $4.42 as our actual, and we actually projected for $4.60 in year 6, and that was due to we lowered our inventory production costs. So overall, we did fairly well on our projections of all these ratios, and we ranked number 1 in each category. Next slide. And I want to touch on the dollar sales for Fame. We are the top. We produce about just above 10 million in dollar sales in quarter 6, and the trend has been constantly increasing through the years. So we've been doing really well on that. And now I want to introduce Jordan, who will be covering the financials.
Now we're going to take a brief look at the year 5 financials for Fame Inc. Overall, through all 3 financial statements, Fame Inc. did a great job with their projections and their actual statements. First thing we're going to look at is the income statement. As we can see here, basically this all resulted, all the variances resulted from the cost of goods sold. Fame Inc. projected that they would have about 9 million in cost of goods sold. However, they actually had 11 million. Now this caused about a 17.22% variance. This would affect basically the entire income statement. Basically the net profit, or from here on down, is affected by that. The net profit after taxes was affected by 29.63%. We projected 5 million net profit, and in reality, we only turned 4,232,000. Now we're going to take a brief look at the cash flow statement. Again, overall, we did a very good job. The 2 numbers that are most important on this, to me, are the cash flow for the quarter, to which we projected 1,509,000. And the actual, which was 1,316,000, this was only about a 14% variance. Overall, for the year, we had about 6% variance, 3,710,000 to 3,500,000. This isn't that bad, and it basically resulted from the fact that we decided to use our excess cash to do things such as dividends, issue or recall our bonds, things such as that. And overall, these basically affected our cash flow. Now we'll take a quick look at the balance sheet. As you can see here again, the variance isn't very much for overall. We only varied 2.91%. Overall, we estimated that we would have about 22 million in the total assets, total liabilities, and shareholders' equity sections. However, we actually turned 21,533,000. While this isn't a very big variance, the variance did result from the fact that we overprojected our inventory. In reality, the inventory resulted from the fact that we gained market share that we weren't expecting to gain. This is a good thing because we didn't have to hold as much inventory. Basically, our inventory, we want that number as low as possible. The lower, the better. The other thing that affected us is the fact that we repurchased the bonds. Now I'm going to pass it on to Danny so that he can give the next section of the financial statements.
Now I'm going to discuss our year 6 income statement variances. As you can see here, our main variances are other expenses, CD interest, and bond interest. The fact that we redeemed more bonds than originally projected at a 5% premium increased our other expenses to $128,000, our CD interest to $65,000, and lowered our bond interest from $200,000 to $61,000, or $227.87% variance. This, however, did not affect our net income or net profit after tax. It only varied at 6.99%. Next, I'm going to explain our cash flow disparity between our projections and our actuals. As you can see, the majority of our variances can be attributed to our financing expenditures. We paid dividends of $5,250,000. We repurchased bonds at $500,000, and we repurchased stocks at $2 million. This, in turn, affected our net cash flow for the year at minus $310,000, which equals a 702.44% variance. Finally, I'm going to discuss our balance sheet. As you can see, our actual cash balance is $3,785,000, which is lower than our projected one at $9,341,000, a 146.78% difference. Our inventory was significantly lower at $800,000 from our projected of $2,090,000, which is a 161.26% difference. This was in part due to our increase in market share and our excellent standing with as far as our sales to customers. These two variances in turn lowered our overall total assets, as you can see, $20,484,000 from our projected of $26,878,000, a variance of 31.21%. In addition, our increase in bond redemptions and repurchase of stocks ended up lowering our total liabilities and stockholders' equity at $20,484,000 and $26,878,000, a variance of 31.21%, as was the same as was our total asset difference. Now I'm going to turn it over to Carlos Ruiz.
Okay, so now we'll be talking about our marketing strategies, and the first thing I'll be touching on is pricing. Basically, when a new model is introduced, we have decided that to increase our prices by 6% in each one of our domestic areas, so America 1, 2, and 3. Similarly, in livestock, we've decided when a new model is introduced, we will increase the price by 8%. This chart right here depicts model number 4. Basically, you'll see the prices before the model is introduced, so with model 3, and then the second column with model 4. You see the prices have increased respectively. Next slide, please. Again, pricing for model 5, we decided to change things up a little bit after our purchase of our consumer preference study. We found a new need that needed to be fulfilled in each one of our markets. So having said that, we diverted from our projections to fulfill this specific customer need. So as you can see here in year 6, quarter 3, this is our projections with new model 5. So it was supposed to be $12.30 for America 1, but we decided to maintain the prices and show some consistency. Michael will be talking about the reason as to why we decided to maintain our prices the same as the previous quarter. Next slide, please. As far as advertising goes, basically with a new model, we base advertising on 2 factors: new model availability and seasonality. When a new model is introduced in in one of our strongest quarters, quarters 2 or quarter 4, we will increase our advertising expense and be more aggressive and increase it by 10% in each one of our domestic areas and 3% in livestock. When no new models introduced in quarters 2 or 4, we have decided to increase advertising by only 8% in each one of our America areas and 2% in livestock. Now, in a regular operating quarters, meaning quarter 1 or quarter 3, we have decided to again show consistency with our strategy, advertising, and remain the same. So our expense will be the same in quarters 1 and quarters 3, and no new models introduced. Next slide, please. For hiring policies, it's pretty straightforward. If we lose an employee, we'll go ahead and hire one the following quarter, and that employee will obviously go into training mode the quarter after and will be active during the following quarter. So again, case in point, in year 5, quarter 2, unfortunately, we lost the salesperson in America 2 area 2. And we followed up by hiring an employee in year 5, quarter 3, who went active in year 5, quarter 4. Thank you. Next slide, please. For salaries and commissions, pretty straightforward as well. Instead of doing commissions for each one of our domestic areas, we have decided to give our employees a 5% increase at year end on top of their salaries. So as you can see here in year 5, quarter 3, you'll see the change, the 5% increase from year 5, quarter 3 to year 5, quarter 4. Again, this applies to only our domestic areas, so market area 1, America 2, and America 3. For livestock, we decided to be more aggressive with commissions to encourage sales. Next slide, please. And finally, for financial strategies, our objective is pretty simple. It's to leverage our expenses with the use of bonds and short-term loans. During years 3 and 4, we weren't as profitable as years 5 and 6. Having said that, in years 5 and 6, having money and being more stable financially, we decided to issue dividends. As you can see here, in year 5, quarter 4, we issued $750,000 worth of dividends, and we increased it as the quarters progressed. Finally, in year 6, quarter 4, we issued $1,500,000 worth of dividends. In CDs, with the excessive amount of cash that we had on hand, we decided to invest in certificates of deposit as well. So beginning in year 6, quarter 1, we issued a $1,500,000 worth of CDs. And in year 6, quarter 3, we issued $2 million worth of CDs. Finally, where we stand as far as liabilities and debt, our debt position as of year 6, quarter 4, our debt to equity ratio is 0.23, and debt to assets ratio is 0.18. Again, what this says is that we have a strong balance sheet and we're able to pay off our loans immediately, and we do not overuse debt, therefore staying away from the whole bankruptcy idea. Now I'd like to turn it over to Michael. Thank you.
So next I'd like to discuss research and development. And first of all and foremost, this was really essential to the product development and launch within our company. And we were really aggressive, as you can see in year 5 and year 6, at $632,000 and $925,000 respectively. And this was purposefully done so that we could meet our targeted launch goals that we will discuss in the next slide. But first of all, we had a projected average quarterly increase within each year of 10% on our R&D. Our overall performance for year 5, we were slightly over our projection by 3%, and in year 6, we actually came in under our projections at minus 8.6 or 9%. So overall, for the 2 years combined, we were actually under our projected goals by 4%. Next slide, please. So next, I'd like to talk about our new product introduction, which actually goes hand in hand and works back to our research and development strategy. Over the years 5 and 6, we wanted to launch 2 new models, Model 4 in year 5 and Q3, and then Model 5 in year 6, Q2. And in keeping with our product strategy of broad differentiation, we met our goal in year 4, launched in Q3, and then in year 6, we actually launched 1 quarter later. And a lot of this came from the fact that we decided to do a consumer preference study in year 5, Q3. And to our discovery, we found that there was a large variance in the product mix that we were currently offering. So we tweaked that basically and came up with our new product mix, which we launched in Q3. And then, as Carlos covered earlier in pricing, we were able to, because of the new mix, we were able to keep our pricing at the same that we had previously done in year 5. Next slide. Okay, and then last I'd like to cover our training. Our overall expense performance, we actually were right on target in year 5, and in year 6 we were actually over 26%, but there's actually a really good reason for this. First of all, as I mentioned earlier, we had our new product launch in Q3 of year 6. As well as with the new product mix, we felt that there would be additional training necessary in order to get the sales team up to speed, as well as our manufacturing team. And with that said, the last point, we wanted to increase training in order to also help us reduce our unit production costs, which would essentially affect the bottom line. So, to wrap up, looking forward for year 7, our goal is to continue as an industry leader. We will do this through strong financial performance, as we have a planned sales increase of plus 20%, and we will also continue that trend through new product innovation, and this will also be supported by an expanded production capacity in nice stock. Thank you.